Okay, so we're looking at a truly wild market anomaly right now in the commodities sector. As of today, July 16th, 2026, the metals market is, well, it's literally splitting in two. We're witnessing a massive divergence, and the data we're going to unpack today, it paints this absolutely fascinating picture of how global capital is shifting in real time. Let's dive right into this explainer.
Here's the central mystery we're trying to solve today. Why exactly is all this money fleeing gold and rushing straight into copper? I mean, think about it. Just a few days ago, everyone was buzzing about inflation data sending precious metals to the moon, right? Well, today, the script is completely flipped. Capital is just ditching those traditional safe havens and aggressively chasing industrial utility.
To make sense of this tale of two markets, here's our game plan. We'll start with a quick overview, look at why gold has stalled out at its peak, and check out the immense pressure squeezing silver. Then, we'll pivot to the breakout star of the day, copper, and finally, track exactly where the cash flow is heading.
All right, part one, the big picture. So looking at the macro environment dictating these massive capital flows, the commodities market is experiencing some severe polarization right now. It's night and day. On one side, the precious metals group is just buckling under heavy profit-taking pressure. That whole euphoria around recent inflation drops, yeah, that's totally evaporated. But on the flip side, the industrial metals group is breaking out. And the crazy thing is, it has absolutely nothing to do with inflation. It's entirely driven by escalating fears over physical supply shortages. It's a classic showdown, really. Macroeconomic sentiment versus cold, hard physical reality.
Moving on to part two. Gold stalls at the peak.
So why has the ultimate safe haven suddenly hit a brick wall? Spot gold is currently locked in this frankly violent struggle right around the $3,980 per ounce zone. All that euphoria from earlier this week, the stuff triggered by cooling CPI and PPI inflation data, has been completely halted in today's trading session. Investors are taking their profits and running for the hills, pushing the price dangerously close to that massive psychological $4,000 support mark. Honestly, we might even see a new local bottom this week, and it's being driven by two massive headwinds.
The first headwind is this specific number, 4.57%. We're seeing a major sell-off in U.S. Treasury bonds right now, which has shoved the 10-year Treasury yield back above this really crucial 4.57% threshold. So what's the big deal here? Well, when bond yields surge like this, the opportunity cost of holding a non-yielding asset like gold absolutely skyrockets. Investors naturally start asking themselves, wait, why am I holding gold when I can get a guaranteed high return straight from the US government?
And then we have the second headwind, which is another totally unexpected number, 41.4. This is the July manufacturing index from the Philadelphia Fed, and it came in significantly stronger than practically anyone forecast. I mean, this report proves the U.S. economy is still incredibly robust. And here's the thing, when the economy is this healthy, investors hesitate. They stop going all in on defensive, safe haven assets like gold. It was actually this burst of strong economic data that directly created the selling pressure forcing gold to retreat today.
Okay, part three, silver's dual pressure.
Now, if gold is stalling, its sister metal is actively suffering, and it's all because of a pretty unique predicament, its dual nature. Unlike gold, which is pretty much purely a financial and jewelry asset, silver lives a double life. Yes, it's treated as a safe haven, but it's also a highly vital industrial raw material. We're talking about everything from electronics to solar panels. Right now, though, this dual nature isn't doing silver any favors. Actually, scratch that. It's a curse at the moment, exposing it to double the trouble.
The result of all this? Silver is trading down, currently sitting around $55.8 per ounce. Unlike gold, which is at least putting up a bit of a fight, silver is facing some very distinct downward pressure. Because of that double life we just talked about, it's getting hammered from both sides. On the financial side, a locally stronger US dollar is just pushing the price down. Meanwhile, on the industrial side, there's this heavy atmosphere of deep caution surrounding short-term industrial demand outlooks. It's basically a perfect storm for silver bears.
All right, let's look at part four, copper, the breakout star. So while precious metals struggle, that capital isn't just evaporating into thin air, it's moving. Copper futures have successfully fought off the broader market trend, touching their highest point in over 3 weeks at roughly $6.34 per pound. Technical analysts are already buzzing, pointing out that if copper can just maintain its footing above that 6.30 resistance level, it's entering a confirmed, undeniable bullish trend.
But what is actually fueling this explosive breakout? Well, it all comes down to a severe crisis on the supply side, specifically originating down in Chile. As you probably know, Chile is the world's largest copper producer, and right now, their mining industry is facing a devastating cascade of disasters. First off, the actual quality of the copper ore coming out of the ground is severely declining. Second, these brutal droughts are causing critical water shortages, and keep in mind, you need massive amounts of water to process copper. And to top it all off, worker strikes are halting operations altogether. The physical supply is quite literally drying up. But hey, a supply crisis is only half the story, right? The other half is this relentless global demand. Despite all the shocks in Chile, the global appetite for copper is being supercharged by two massive, unstoppable macroeconomic forces: the global transition to green energy and the incredibly aggressive infrastructure construction for AI data centers. Both of these industries require absolutely staggering amounts of copper wiring and components. So what you have is an unstoppable force of demand, meaning a crumbling wall of supply.
And that brings us to part five, where is the cash flow actually going?
Looking across the whole metal spectrum, the ultimate takeaway here is a massive tactical shift in global cash flow. Capital is actively rotating, and fast. After days of euphoria driven by cooling inflation news, investors are executing serious profit-taking on the precious metal side. They're grabbing those gains and aggressively rotating them into base metals, specifically copper. They're trying to catch the bottom of these industrial assets, because the narrative of physical supply scarcity has just become way too urgent to ignore. We are literally moving from a market driven by macroeconomic feelings to one driven by physical, real-world deficits.
All of this leaves us with one final, critical question to consider. How long will this tactical shift last as physical supplies continue to dry up? Can gold regain its footing, or will the undeniable reality of copper's supply chain crisis just dominate the markets for the rest of 2026? The charts tell the story of today for sure, but the physical constraints of our world will dictate tomorrow. Thank you so much for joining me for this explainer, and definitely keep your eyes on those supply chains.